In week 5, we're going to look at how to match the employer objectives to the right type of qualified plan. This is important because the viewpoint on the CFP exam is that you are working for the business owner. You are trying to maximize, and this is normally, not every owner will do this, but generally you want to maximize the owner's benefits and minimize those of the rank and file. And that's what we're going to take a look at this week. How do we properly design the plan? How do we do the best to make sure the owner is getting his or her money's worth for installing a qualified plan? The employer, as the owner of the company, has certain goals that they want to accomplish. There could be personal goals. Some of them maybe want to make sure that their employees have an adequate retirement plan. Others are concerned just about themselves and want to make sure they maximize their benefits. Others are concerned about the plan costs. Still, other owners may be concerned about the complexity of the plans and the difficulty it might be to explain plans to employees. Others might be concerned about cash flow issues where they might not be able to make contributions in the future. So all of these are things that need to be considered by the financial planner when designing a qualified plan. The usual objective of an owner of a business is to maximize the contributions and benefits for himself or herself, and maybe also for the other highly compensated employees to keep them happy and stay with the company. One question though to ask is, can the business afford the contributions? Remember, if you have a pension plan, that's anything that's not a profit sharing plan, there are mandatory contributions that need to go in each year. So for pension plans, and especially the defined benefit pension plan, you need to make sure the company has a stable or increasing cash flow and is going to be able to afford the contributions in the future, even if there's a weak economy, a turn down the economy, or if they're in a cyclical business and wind up being on the wrong part of the cycle in the future. They got to have the money to put in when you have a pension plan. Now, on the profit sharing types of plans, there's a lot more flexibility there. In fact, in the profit sharing plans, you could theoretically skip a couple years worth of contributions and still be all right, because the only requirement according to the Internal Revenue Code is that profit sharing plan contributions be substantial and recurring, but nowhere in the Internal Revenue Code does it define what that means. The thinking is currently that you got to put something in every 3 years or so. For companies that have fluctuating cash flow, it is the profit sharing types of plans that are really the only thing they can go with. They cannot afford to commit themselves to mandatory contributions in the pension types of plans. Another question to ask is the owner older than the other employees? When this is the case, it might lean more towards having an age-weighted profit-sharing plan, or maybe the defined benefit pension plan, where the owner would benefit by a greater percentage of contributions going to that person. And one final question is, the owner's savings need, is it over 25% of his or her compensation? And is it greater than a $52,000 contribution each year to stay on schedule to provide the owner with an adequate retirement benefit? If that is the case, then you're probably going to have to go with a defined benefit pension plan, because that's one of the few plans in which you can exceed the 25% of compensation or $52,000 limit, which you would have in a defined contribution plan. Here are some possible ways of increasing the amount of the employer contributions going to the owner and the other highly compensated employees. One method is to use a unit credit benefit formula in a defined benefit pension plan. A unit credit benefit formula is not only taking into account the compensation level for each employee, but also giving credit for years of service with the company. If the owner has been around the company a lot longer than most of the rank and file employees, this can be a big benefit in helping even more money go towards the employer owner's retirement. Another technique is to use a target benefit plan or an age-weighted profit sharing plan. Now, the target benefit plan is going to give a kind of extra credit for older employees. So there is one column for the compensation that a person makes, but there's also another column for just how old you are. And each of those columns gets a certain number of points. And so an older employee, everything else being equal, is going to get a little bit more of a contribution on an age-weighted profit-sharing plan. In a target benefit plan, same thing. The difference, though, is that in the age-weighted profit-sharing plan, it has flexible contributions because it is a profit-sharing plan. On the target benefit plan, there are going to be mandatory contributions because it is a pension plan. The ADP test, the actual deferral percentage test, and you'll study this later on in the course, allows for higher contribution rates for highly compensated employees. For example, if you have a profit-sharing 401k plan and the non-highly compensated employees are deferring 4% of salary, under the formula, the highly compensated employees could defer 6% of their salary into the plan on a pre-tax basis. Another strategy for helping the owner meet his or her objectives is to integrate the plan with Social Security, which can work for basically all plans except ESOPs. And the way this works then is for employees who make more than the taxable wage base, which this year is $117,000, for those employees, they do not have an employer contribution going to the retirement part of Social Security on the compensation they make, because under the Social Security rules, it stops at the taxable wage base. So if you take a look at a person who's making, say, $50,000, they're getting the full percentage into their qualified plan plus the portion of Social Security retirement being paid by the employer. And so the percentage is actually greater for a person making less than $117,000 versus a highly compensated employee who's making more than that, who doesn't get that extra contribution from the employer towards the Social Security retirement. So the Social Security integration makes up for that by allowing for an additional contribution into a defined contribution plan or an additional benefit into the defined benefit plan on the portion of compensation above the taxable wage base. Another objective of an employer is to attract quality employees and to keep them around for a while. One technique for doing this is to simply offer a defined contribution plan, because maybe the employee might view this as a positive savings vehicle for them. For example, a stock bonus plan, the company is handing over company stock and putting it into the plan for them. The other types of profit sharing plans doing the same thing, only maybe with cash contributions. And if it is a profit sharing 401k plan, the employee himself or herself has the ability to put away possibly up to $17,500 a year from their salary, and if they are 50 or older in age, possibly another $5,500 on top of that. So employees might view that as a valuable thing, and they would enjoy being with a company that does this, and that's the idea of these kind of plans. For teachers in public school systems and for workers in nonprofit organizations, the ability for employees to defer part of their salary, which is what a tax-deferred annuity, otherwise known as a TSA, tax sheltered annuity, or a 403B plan, can be very valuable for the employer and the employees. If the owner's objective is to provide an adequate replacement income at retirement, especially for the owner, the only way you can really do that is through a defined benefit pension plan, because the employer must guarantee the investment performance, must make up any shortfalls. It is the only way in which you can really guarantee that the benefits are going to work out. Defined contribution plan does not do that, and the employees are responsible for the investment performance in the defined contribution plans. But defined benefit pension plans, the employer is funding it, and they got to make up any shortfalls. What you would do then is use a technique called the final average pay in the defined benefit plan formula. There are two methods basically that can be used. The average pay method, the career average pay, career average pay, in which you blend together all of the compensation made year by year over the whole length of time the employee worked for the company. Now that average could be well below what the average would be for the final average pay method, in which you might include the highest 3 years or the highest 5 years, or maybe the highest 3 of the last 5 years of compensation, and put that compensation level into the plan formula. mandatory employer funding on a defined benefit pension plan. And this technique will assure above anything else that older employees will be able to achieve their defined benefit level, especially an older owner who has not done sufficient retirement planning to date. If the owner wants to create incentives for the employee to work harder to maximize the company's performance, a common technique is to use a profit-sharing type of plan. This way, there is a relationship between the employee's thought process as to how hard to work, because if they're involved with the price of the stock, especially in a stock bonus plan or ESOP or LESOP plan, theoretically they might have a psychological incentive to work harder to improve the profits so that the price of the stock will go up. Now, ironically, in real terms, they're actually better off if the stock price goes down, because then the next month's employer contribution will buy more shares with the same dollar amount. But people don't think like that necessarily as employees, and so this is one technique that can be used. Another is a cash balance pension plan. So even though it's a defined benefit plan, it acts much like a money purchase plan. So it's kind of a hybrid type of investment where the person is getting a fixed percentage of compensation and then getting an interest rate on top of that, much like a CD type of investment. And a younger person who has a lot of years of service with the company has the opportunity for a lot of employer contributions with earnings on top of that. And it can create a rather large sum of money by doing this. So these are some ways to provide employee incentives to maximize performance.